The importance of long-term investing. Bogle begins by discussing the importance of adopting a long-term perspective when investing. He emphasizes that the market is unpredictable in the short run, but historically, it has grown in value over the long run. He stresses that investors who focus on short-term speculation are more likely to fail compared to those who invest with patience and discipline. The case against active management. A central argument in the book is that most actively managed mutual funds fail to beat the market consistently, especially after accounting for fees. Bogle shows that active managers often underperform the market due to the high costs associated with frequent trading, research, and management fees. Even before fees, the majority of active funds do not beat their benchmarks, such as the S&P 500. Over time, the compounding of high fees erodes investor returns. This leads Bogle to advocate for passive investing, where investors buy a broad market index fund that tracks the performance of a major market index like the S&P 500. The power of low-cost investing. One of the book's most compelling arguments is the importance of keeping investment costs low. High fees, whether from active management or excessive trading, reduce the long-term growth of your investment portfolio. Expense ratios. Bogle explains that index funds, which passively track an index, have much lower expense ratios than actively managed funds. These lower costs mean that investors keep more of their returns. Impact of compounding fees. A small difference in fees, say 1% per year, can lead to a significant difference in the final value of an investment over several decades due to the power of compounding. The efficient market hypothesis, EMH. Bogle supports the efficient market hypothesis, which argues that stock prices reflect all available information at any given time. According to this theory, it is impossible to consistently beat the market because stock prices already incorporate all publicly known information. Thus, it is more sensible to invest in a broad market index fund that mirrors the performance of the entire market rather than trying to pick individual stocks or time the market. The idea is that while some may outperform the market in the short run, over the long run, the odds of doing so consistently are slim. Bogle champions the simplicity and reliability of index funds. By buying an index fund, investors are essentially buying a small piece of every company in the index, spreading out their risk and ensuring they capture the overall growth of the market. Key benefits of index funds include diversification. By owning an index fund, you are automatically diversified across many companies, sectors, and industries, which helps to spread risk. Automatic rebalancing. Index funds automatically adjust to reflect changes in the market, so investors don't have to worry about manually adjusting their portfolios. Consistency. Historically, index funds have delivered returns that are close to the market's average return, with fewer fluctuations than most actively managed funds. Bogle cautions against the common practice of trying to time the market, buying and selling stocks based on predictions of future movements. He points out that even experts are unable to predict market movements consistently, and trying to time the market can result in missed opportunities and losses. He argues that staying fully invested, particularly in broad market index funds, is the best way to ensure consistent long-term growth. Trying to time the market is a losing game for most investors, as they often end up buying high and selling low, which leads to poor investment outcomes. The role of bonds and asset allocation. In addition to stocks, Bogle discusses the importance of bonds in an investment portfolio, particularly for investors who are closer to retirement. While stocks offer higher long-term returns, bonds are less volatile and provide stability, especially in uncertain economic times. He advises a balanced approach to asset allocation based on an investor's time horizon and risk tolerance. While stocks should make up the majority of a portfolio for younger investors, older investors nearing retirement should consider increasing their bond allocation to reduce risk. Bogle emphasizes the importance of sticking to a disciplined, long-term investment plan. He stresses that investors should avoid getting caught up in the short-term noise of the market, whether it's daily market fluctuations, economic news, or the latest trends. He argues that the key to successful investing is having patience and sticking with your chosen strategy, even during times of market turbulence. The best way to do this is through the use of automatic investment plans, e.g. dollar cost averaging, which help investors stay committed to their long-term goals without being swayed by short-term volatility. The impact of taxes on investment returns. Bogle points out that taxes can significantly erode an investor's returns over time, especially for those with high turnover in their portfolios. He advocates for tax-efficient investing strategies, such as holding index funds in tax-advantaged accounts like IRAs or 401ks. For taxable accounts, Bogle recommends considering tax-efficient funds, which are designed to minimize taxable distributions, and holding investments for the long term to take advantage of long-term capital gains tax rates. The dangers of overconfidence. Another key theme in the book is the danger of overconfidence among investors. Many investors believe they can outsmart the market, but as Bogle shows, this is rarely the case. The data overwhelmingly suggests that over time, index funds outperform most actively managed funds due to their lower costs and market-matching returns. He encourages investors to recognize the limits of their knowledge and to avoid the temptation to chase after high-risk, speculative investments in the hope of beating the market. The role of financial advisors. Bogle is not opposed to working with financial advisors, but cautions investors to be wary of high fees that can eat into their long-term returns. He recommends seeking advisors who charge flat fees or use low-cost investment strategies, such as index funds, rather than those who push high-fee, actively managed funds. He also highlights the importance of finding an advisor who puts the interests of the client first, in line with the fiduciary standard, rather than one who is incentivized to recommend products that generate commissions. Finally, Bogle reflects on the broader impact of his advocacy for index funds. He argues that the rise of index funds has democratized investing, giving individual investors the ability to build diversified, low-cost portfolios that were once only available to institutional investors. He views the growth of index investing as one of the most positive developments in modern finance, as it has made investing more accessible and less costly for millions of people. Conclusion: the importance of simplicity and discipline. Bogle closes the book by reiterating his central message: the key to successful investing is simplicity and discipline. By avoiding the traps of high fees, market timing, and speculative investments, and instead focusing on low-cost, diversified index funds, investors can increase their chances of achieving their long-term financial goals. In the end, Bogle advocates for a common-sense approach to investing that relies on the power of time, compounding, and consistent, low-cost investing strategies. This summary covers the main points of the Little Book of Common Sense Investing, but the book itself goes into greater detail on the evidence supporting Bogle's arguments, the history of the index fund revolution, and case studies of how different investment strategies perform over time. The core takeaway is simple: low-cost, passive investing through index funds is one of the most reliable ways for individual investors to build wealth over time. By following this approach, investors can avoid common pitfalls like high fees, overconfidence, and market timing, and instead focus on achieving consistent, long-term returns.